Hello everyone, I'm Sebastian Y and this is Foundations of Economics. In this video I'm going to talk about the banking system and how it interacts with the money supply. I'm going to use a simple example to illustrate a banking system and the effect it has on the overall money supply. Consider a simple economy with $100 in total currency. If there are no banks, all of this currency remains in circulation, and so $100 is our total money supply. Now suppose there is a bank that functions only as a depository institution, meaning that people can keep their money safe in the bank and withdraw it at any time. The bank does not offer any loans. Reserves are the deposits that banks do not loan out. If a bank does not offer any loans, then 100% of its deposits are in reserve. We can draw up a simple balance sheet for this, where we write our bank's assets and liabilities. In a bank's balance sheet, the assets must equal the liabilities. Liabilities are the amounts that are owed. Suppose that all $100 get deposited in the bank. So far in our example, then the bank is holding exactly $100 in reserves. Remember that funds deposited in checking accounts still count as money. In this example, the $100 of currency is gone out of circulation, but people can still withdraw that money from their checking accounts, and so the total money supply is still $100. Now let's suppose that our bank decides to offer some loans. A bank can't loan out all its deposits because then they would not have anything left in reserve in case people want to withdraw. In fractional reserve banking, banks loan out a portion of deposits while maintaining the rest in reserve. The government typically requires banks to maintain a minimum amount as reserves, but some banks will choose to hold more. We're going to use the variable R to represent the fraction of deposits held in reserve. That is called the reserve ratio. Let's suppose that in our example, the reserve ratio is 10% or 0.1. This means that our bank is going to hold 10% of its total deposits as reserves, so that will be $10, and they're going to loan out the rest, so we'll have $90 worth of loans. This means that of the $100 of total currency, 10 is being kept in the bank, but 90 is being loaned out. And so those $90 worth of currency have re-entered the money supply. But at the same time, the $100 in deposit is still considered part of the money supply because it can be withdrawn and used. So now our money supply is the $100 of deposits plus the $90 of loans for a total of $190. This shows that fractional reserve banking increases the money supply, even though the total amount of currency did not change. Note that this does not increase the total amount of wealth in the economy, just the amount of money. Of course, in a more realistic economy, we don't just have one bank, we have multiple banks. That $90 that's been loaned out could then be deposited in another bank. So let's draw up the balance sheet for our second bank. Our second bank is going to receive $90 in deposits. If the reserve ratio is 10%, then they're going to have to reserve $9, but they're free to loan out the remaining $81. With two banks, the money supply is the $100 deposited in the first bank, plus the $90 deposited in the second bank, plus the $81 in currency that's now been loaned out and has entered circulation. This gives us a total money supply of $271. We could then repeat this process with a third bank, where we deposit the $81 into the third bank, they keep 10% of that in reserve, and then loan out the rest. And we can keep doing this process ad infinitum. To calculate the total money supply with this arbitrarily large number of banks, we have $100 deposited in the first bank. 10% of that is kept in reserve, and 90% of that is loaned out. And so that increases the money supply by $100 times 0.9. That's 1 minus R. That bank is then going to take 10% of that in reserve and loan out 90% of the rest. And so that's going to be the $100 times 0.9 times 0.9 again, so 0.9 squared. And this is going to keep going. At each term, we add one more to the exponent, and that just keeps going on forever. Of course, as those exponents get bigger, the numbers get smaller and smaller and smaller. What we have here is a geometric series. We can see a pattern emerging here, so let's generalize this into a formula. Suppose that C is the amount of currency in the economy. R is still the reserve ratio. So our money supply will be C plus C times 1 minus R, C times 1 minus R squared, and so on. This is an infinite geometric series that works very similarly to the formula for the present value of an infinite income stream that we worked with previously. This conveniently comes out to C over R. For the purposes of this class, I am going to skip the calculus proof of this. Let's apply this to our example. In our example, our money supply will be our currency of 100 divided by our reserve ratio of 0.1. This is going to give us a total of 1,000 for our money supply. Let's think about our money supply equation a little bit more. First of all, since R is always less than 1, M is always greater than C. That is, the amount of money in the economy is always greater than the total amount of currency. If the reserve ratio goes down, then the money supply will go up. This means that the more that banks are willing to lend out, the more money there will be in the economy. We define the money multiplier as the amount of money in the economy generated by each dollar of currency. That is going to be equal to 1 over R. In our example, the money multiplier is 1 over 0.1, or 10. And we can see that there is, in fact, 10 times the amount of money in the money supply as there is currency. 1,000 is 10 times 100. Another way to think about this is that at every stage, we are loaning out money and then depositing what's left in another bank. And if we go through this ad infinitum, all $100 will eventually get deposited in a bank. And so there's no currency out there. It's all in banks. This means the total amount of currency in banks is 100, and that has to be 10% of the money supply because that is the reserve ratio, and 100 is 10% of 1,000. Finally, I want to talk a little bit about the Federal Reserve System in the United States. Central banks are the institutions which oversee the banking system that we just talked about and the money stock in a country. In the United States, the central bank is the Federal Reserve, which we just call the Fed for short. The role of the Fed is to regulate the national banking system and to control the money supply. Since banks only hold a fraction of their deposits as reserves, it's possible to have people trying to withdraw money that isn't there. This is called a bank failure. The Fed provides a mechanism to prevent bank failure as a lender of last resort to banks. If banks are running out of reserves, they can go to the Fed to get a loan. Broadly, the Fed is in charge of the United States monetary policy, which refers to the policies involved in controlling the money supply. Let's talk about a few tools that the Fed has available to them to control the money supply. The most prominent tool in the Fed's toolbox is called open market operations. If the Fed wants to reduce the money supply, then they need to take money out of the economy. They do this by selling government bonds to the public. When people exchange money for bonds, the Fed effectively takes money out of the economy. If they want to increase the money supply, then they will buy up bonds from the public in exchange for money, thus sending more money out into the economy. The Fed can also add to the money supply by loaning reserves to banks. Anytime the Fed loans out money, that's going to add more money into the money supply. We define the discount rate as the interest rate on the loans that banks take from the Fed. The Fed has complete control over the discount rate, and a higher discount rate will discourage banks from borrowing from the Fed, while a lower discount rate would encourage more banks to borrow from the Fed. As such, the Fed can raise the discount rate to decrease the money supply, or they can lower the discount rate to increase the money supply. Finally, the Fed can also make adjustments to reserve requirements. Reserve requirements set a minimum amount of reserves that banks have to hold. Increasing reserve requirements forces banks to lower their reserve ratios, thus decreasing the money supply, as it will decrease the money multiplier. Conversely, decreasing reserve requirements can allow banks to increase their reserve ratios, thus increasing the money multiplier and increasing the money supply. Note that the Fed's tools to control the money supply are somewhat imprecise, because they cannot control the propensity of households to make deposits and the propensity of banks to make loans. For example, if the Fed were to decrease the reserve ratio, that's no guarantee that the banks would actually loan out more money. In these last two videos, we have introduced the concept of money and the banking system that money operates in. If you have any questions, feel free to let me know. Thanks for watching.